Good afternoon, everyone. Happy New Year. Thank you for joining us today. We're going to kick off 2023 with our financial and market update today. I'm Jeff Carbone, certified financial planner, managing partner at Cornerstone Wealth. Of course, joined as always with our chief investment officer and chartered financial analyst, Cliff Hodge. Good afternoon, Cliff.
Jeff, great to see you.
As always, a fair amount of information to go over today. So as we're going over, if there's questions, write it down, reach out to your advisor, reach out to someone on the Cornerstone team. We'll be happy to answer, spend some time, go over what we discussed. So going to start, just a reminder, we are going to be recording. So you certainly, when you get it, feel free to share it with colleagues, friends, family. We'll also be posting it to our website. We'll post it on Facebook and our YouTube channel. So again, direct folks towards those vehicles, and they can certainly get an update. As in all our sessions, our mission today is to provide you clarity and confidence as the cornerstone of your financial life. So let me begin with going over the agenda today. So again, you'll see a fair amount of information, but we're going to basically do a review of the 2023 planning, more tax changes that occurred, but also some updates on the figures and what could be done. Cliff is going to spend some time, not a whole lot, just a little time going back in a little bit of a quick 2022 review. We'll move on to a 2023, more important, the outlook. What do we see ahead? We'll do a kind of review of the Cornerstone dashboard. I know that's been a newer feature we've added, and we'll kind of go through that dashboard. Cliff will take you through the investment process, the three key pillars of the macroeconomics, the fundamentals, and the behavioral science we're looking at. And then, of course, we'll end with the portfolio positioning. So Cliff, why don't you share? We'll go into the effective for 2023. So in December 29th of 2022, so just a few weeks ago, they were hard in Washington trying to get this law passed, and it did. It is the Secure Act 2.0. So they made a few additions, few changes. There's a lot to be looked at. I'm just going to put a couple highlights. Some of it is effective for 2023. Some took it into 2024, and you'll also see into 2025. So first couple points in 2023, again, so started January 1. RMDs, or required minimum distributions, were now pushed back. We know they were pushed from 70.5 to 72. They're now in 2023 to age 73. And again, they will also be pushed back if you're based upon your age as high as age 75. So again, some changes on required minimum distributions. Another thing that came from the plan that did not impact, we do have quite a fefew clients that utilize the strategy of a qualified charitable distribution, and that is where you're giving money from your IRA as part. You can up to $100,000 can be given, and again, as long as you're over 70.5, you basically helps you from a tax perspective. Another big change where some clients do have simple IRAs, or employers that they work for offer simple IRAs, or if they're self-employed, they have their SEP accounts. They now added that rather than just doing the pre-tax money, you will be able to do a Roth simple and a Roth SEP. So again, those are meaning the gross dollars will be taxed. You will not get tax deferral, nor will you get pre-tax money. So we can certainly talk more about that. There's also a few changes. I won't go over all of them here, but they enhanced the access to retirement funds. So, there's a lot hurricanes this year, wildfires, floods, etc. A lot that went on, that has been going on. Rather than just having hardship withdrawals, they've made it easier to get some access to your funds when they're needed prior to retirement. So again, more on that if you have questions or if you're dealing with that situation. Big change in 2024 that's coming would be on the ability for 529 plans. We have clients that have done a great job funding their education for their children or grandchildren, And at the end, they may still have some dollars left over. And the question is, what do I do? Well, they've addressed it here where as long as you've have held the 529 for over 15 years, you'll have the ability to roll some of those funds into a Roth IRA, maximum of about 35,000, but another new strategy that we can discuss about employing. Another change next year, not 2023, but 2024. If you're over an income limit, about 140,000, if you're making over that amount and you're doing your catch up, they're going to force those dollars to not be pre-tax, but you could still save, but they will be Roth dollars, meaning you pay the tax today, but it grows tax free. Another change in 2025 coming will be additional catch up provisions. You could see from age 60 through 63. You'll have the ability not just to do the 7,500, but to do additional dollars towards retirement. So again, a lot in the plan that went through. So just a couple updates as we turned the clock here into 2023. 401k, 403b, 457 contributions are now up to 22,500. From the employee side, you can put that amount in. And if you're over 50, an additional $7,500 contribution. So again, total 30,000 for the year. So again, able to put a fair amount of money there. In terms of IRA and Roth IRAs, the dollar limits for 2023, you'll see 6,500. And again, if you're over 50, the catch up of $1,000. So $7,500 cap for IRA and Roth IRAs in 2023. I mentioned simple and SEP accounts. These are the dollar amounts you're able to put in. Now, whether it be simple or Roth or traditional pre-tax simple money. One thing on the simple, I didn't mention that the employer needs to implement that. So there's some forms, they need to add that option in there. But from the simple, you'll be able to put 15,500 and a catch-up provision of 3,500. If, again, self-employed and you're contributing to a SEP account, your maximum contribution would be $66,000. The health savings accounts continue to be pretty popular as medical insurance has continued to rise. So the high deductible plans, if you do have a high deductible, you can contribute it for a family, $7,750 plus the catch-up provision. So total of the $8,750. For single, you'll also be able to just do the $38.50 for the year. The last couple things more from the estate. Annual gifting did go up. It's up to now $17,000 per person. So you can gift $17,000 to as many people as you wish, should you wish to do so. And the estate lifetime gift is now over $13 million per person. But caveat, remember that is set to expire or sunset in the year 2025. So again, just a little quick update on the tax side from planning. So just wanted to share that information with you all today. So I'm going to move back into investment management. So Cliff, let's take a look back maybe first into 2022, and then we can kind of start looking forward. So I'm going to hand it back over to you here.
Yeah, thanks, Jeff, and thank you for going through the new updates to planning and tax. I always learn something from you on these webinars, and maybe I'll take a moment to give a shameless plug to Cornerstone. Excellence on the planning and the tax side, and pursuing excellence on the investment side, I think is something that sets us apart and makes us unique in the space. And so I'm proud to have you as a partner and know all the great work you guys are doing on the planning side. But as we contemplate, the path ahead for the markets in 2023, it's always a great exercise to just take some time to review and reflect from where we came. What's the saying, Jeff? I'm going to butcher it, but you can't know where you're going until you know where you've been. And where we've been in 2022 was really an extremely challenging place. I've highlighted some of the themes on the right-hand side. The highest inflation in over 40 years, got up to 9% year-over-year CPI. most aggressive Fed since Paul Volcker back in the 80s, who broke the back of inflation. We had the war in Europe with Russia, Ukraine, zero COVID lockdown policies in China, which completely wreaked havoc on supply chains and exacerbated the inflation that we talked about. And by the way, a pretty hotly contested midterm election. So no surprise that the challenging environment was also challenging for markets. So just how bad was it? What I've got here on the slide is returns of a 60-40 S&P 500 and Barclays Ag going back to 1950, and third worst year on record for the 60-40, down 16%. Yeah, only the global financial crisis in 2008 or the hyperinflationary oil embargo in the 70s were worse years for the 60-40 than what we had last year. So if you were invested in a diversified portfolio and you were down less than 16%, fortunately, as many of our clients were last year, you had a pretty decent year. No one likes to be down. It was a tough year, a challenging year for our clients, but it is important to be able to preserve some capital and try and limit the downside where you can in bad years, so that you can compound from a higher base moving forward. So that's really what we're focused on now. So if we break it down a little bit further, the S&P was down nearly 20%. NASDAQ growth stocks, which have really been a fan favorite over the past decade, down more than 30%. And so if you were in stocks, if your portfolio was 100% invested in stocks and you were down less than 20, again, a pretty relative decent year. Interestingly enough, some of the more speculative areas in the market were down even worse. Jeff, I don't remember how many questions we got about Tesla or Bitcoin or crypto back in 2021, but as fate would have it, Bitcoin and Tesla were both down essentially the exact same amount in 2022, and that was down a whopping 65%. And if you were unfortunate enough to invest with Sam Bankman-Fried or FTX, like many major financial institutions did, those investments are now worth zero. So, we talk a lot of our conversations are about returns and about risk, and there's no question that they're very important, because that's what helps you achieve your long-term goals. But I do also want to take a moment just to recognize the value of risk avoidance. So being able to sidestep some of these major blowups. By and large, we've done a really good job of that, protecting our clients from some of these episodes, and that's something that I'm especially proud of. Last little bit about 2022 before we move on. What made it especially painful was the diversification of the 60-40 did not work. Bonds were down 13%, which is the worst year on record, going back at least 50 years. Prior to 2022, the worst year on record for the ag was 1994, and it was down 3%. So we were down over 4x of the worst year on record for bonds. So as I said, traditional diversification of only stocks and bonds did not work last year. But fortunately, most of our clients do have exposure to alternatives, which did work wonderfully and are a really important part of what we now call the three-dimensional, the 3D portfolio, invested in stocks, bonds, and alternatives, right? And that's going to be really important in 2023 and beyond. So briefly, we'll just look at sectors and risk factors in the equity market. Really no place to hide. Energy was the lone standout, up 65% last year, followed by utilities, which were essentially flat, up 1.6. Everything else, you look at technology stocks, down nearly 30. Communication, a lot of the FANG names are in the communication sector, down 40% last year. Discretionary, drugged down by Tesla, Amazon, down 37. You look at on the factor side, again, growth, momentum, had very tough years. Even defense stocks down 8. Equity income oriented stocks were really the only place to hide. So just kind of shows how difficult it was for risk assets in 2022. And Jeff, I know we share this sentiment. We're both happy to see the calendar page turn to 2023.
Absolutely, Cliff. And, you know, when I look at that chart on energy, it made me think not exactly 2 years ago, when you look at energy, during the COVID start, right around March, oil, they were trying to pay people to hold barrels of oil because they had too much supply, right? What a difference, again, 2 years makes. So, so thanks for the look back. We certainly know the volatility. There was certainly a volatile one for everyone, as you mentioned. When you look at what you just shared, whether it be asset categories or sectors, really all being negative except energy. It really tells a story how the impact of just the economy slowing, trying to unwind all that fiscal and monetary stimulus that was thrown in to the economy. How quickly rates rose, along with inflation on its side, which we now know was not transitory, was never transitory. And again, adding in the war between Russia and Ukraine, and other catalysts, all really tell the story of 2022. So 2022 is in the books. Now let's start talking about where we are. We're in the new year. 2023 is here. Like you said, we're all glad to turn that page in that chapter. So let's look at the outlook of 2023.
Yeah, thank you, Jeff. Yeah, for 2023, I think the good news is that we've got a very high degree of confidence that 2023 is going to be a much better year for investors, in that we expect positive returns for all the major asset classes, equities, bonds, and alternatives. Though we do think returns are likely going to be modest, and really the bulk are going to be driven by fixed income, bonds, and alternatives. So it's really going to be important for our investors, our clients, to remain diversified and by and large to play defense. So by now, most folks should be aware of our dashboard. For those who sent in feedback, certainly really appreciate that. We've made some tweaks to it, and we'll continue to iterate on it. But our dashboard is designed to tie back to our three key investment pillars, as you mentioned in the kickoff, Jeff, and that's the macroeconomic, the fundamental, and the behavioral. And what we really want and what we really look for among the pillars is alignment, right? We want things that work well in the macro environment, which we find ourselves, that are cheap and that are unloved. And this year, we think that constellation is going to line up very nicely for bonds. So I'll just kind of walk through each of these briefly. We'll go into a little bit more detail through the presentation, but we'll start with the macro business cycle. We're late cycle, heading towards a probable recession, though the timing does still remain a little bit unclear. The economic data, both the soft leading indicators and now the hard data, most recently illustrated by very weak retail sales and industrial production, have really started rolling over fourth quarter of 2022 and now into the first couple of weeks in 2023. However, the jobs market really remains the last man standing. So that does, the fact that the labor market is so hot, even looking at the claims data this morning, it could mean that the economy may hold up longer than expected, which makes timing the start of the potential recession a little more tricky. From a quad perspective, we're looking at 3 quarters of quad 4 on the horizon, which again is the macro environment where both GDP growth and inflation flow together simultaneously. Historically, that's the worst macro regime for equity and for risk assets, but the best for treasuries and for high quality bonds. So that's another check mark, if you will, for fixed income. The Fed is still aggressively tightening. We've got now the Fed funds rate is up to 4.25%, up from essentially 0. We've got $95 billion a month in quantitative tightening rolling through the system, shrinking their balance sheet. Though from a rate hike perspective, it does seem that we are getting closer to the end of the line, which will certainly be a positive development. The market's pricing in 2 more hikes of 25 basis points in February, 25 basis points in March, and then stopping at about 5%, and then actually forecasting cuts by year end. But this is really interesting because we're actually seeing a little bit of a game of chicken. As I said, the market's pricing in cuts, but the Fed most recently told us that they want to take the Fed funds rate up to 5.5%, which is another 50 basis points higher than what's getting priced in, and then they want to hold. So we're going to be watching this very, very carefully, as we always do, because how these things play out, whether the Fed blinks and comes down to the market, or the market moves up to where it's in line with the Fed, because the resolution of how these things play out is really going to push assets significantly one way or another. So we'll be watching the macro very closely, as we always do. Next, just briefly, fundamentals. Equity valuations are okay. We're about 18 times on the S&P, though we are more constructive ex-US, so international developed and emerging markets we think are going to be more attractive in 2023. Fixed income, on the other hand, valuations are very attractive. Yields are at or near 20-year highs. Spreads are okay, but you're actually going to get paid to own bonds again, which is a nice change in what we've experienced over the better part of the past decade. Earnings. So earnings season is just getting underway with big banks. As of right now, reported earnings are down about 5% year over year. We've only had about 10% of companies report so far. So the heavy lifting really is going to happen here over the next 2 weeks. But we've got that on watch for the dashboard, where we may end up downgrading the actual earnings to falling, which in the grand scheme of things is okay, because historically earnings bottom before the equity market. So we'll be watching that closely. Then lastly, on the fundamentals, earnings expectations still too high. 5% growth this year, another 5% in 2024. We're going to take the under on that. If you look back historically, since World War II, earnings per share have actually fallen on average by 11% during recessions. So even if we get a slowdown and not a recession, we still think expectations are going to come in. And again, the market is not going to be able to bottom until that happens. Last but not least, behavioral. Mixed signals here. Just briefly, institutions are broadly underinvested, which is bullish. Retail is largely back in the pool, which is bearish. Mixed overall for equities. But as we'll see later on in the presentation, kind of exactly what we want to see for fixed income. Institutions are underweight. Volatility is still high in interest rates. And so that's typically a pretty good setup. But before we move on, just a quick reminder that what we're looking for among these pillars is alignment. We use this is our process to help guide our risk decisions, where we want to be more aggressive or whether we want to play defense. And now, by and large, we want to be playing defense. So we'll breeze through the next two slides. This is just a little bit more in depth on the macro side. Business cycle here, late cycle in the U.S., Eurozone and China potentially already in recession. The right-hand side, you look at these dark green bars. Recessions are typically poor for stocks, great for bonds. So that gives us more confidence in the playbook, so to say. From a quad perspective, 3/4 of quad 4 as we hit on. So that's again where both growth and inflation decelerate simultaneously. Again, worst macro regime for stocks, best macro regime for fixed income. So again, gonna continue to pound the table for bonds here. Lastly, we'll just look at fundamentals. So what we've got here on the equity side, these gray bars are valuation ranges over the past 10 years for the respective indices. The blue line is the average, and then the green diamond here is where we are today. So for the equity chart, lower is better. We look at the S&P, it's okay. 18 times next year's earnings, kind of in line with the longer run average. Value actually looks more attractive. A discount to the S&P, a little bit below the average here. No coincidence that our equity portfolios have more of a value and more of a quality tilt to them. I'll call out the world ex-US. International Developed, EM. So these are international stocks. Again, pretty significant discounts to the S&P from a valuation perspective, discounts to where they trade relative to their own history. That's what we like to see from a fundamental standpoint, especially as it relates to the valuation. Another bit of a tailwind that we think is on the table for 2023 for international stocks is that we think the dollar has peaked. If you look at the chart, what has been a pretty stiff headwind for international stocks should now be a tailwind moving forward. Briefly, we'll hit on sectors here. Nothing really major jumps out other than energy. It's still really cheap. I mean, even after a 65% year, 10 times next year's earnings, massive discount to where it typically trades, massive discount to the S&P. So we are remaining overweight in our individual stock portfolios with an energy overweight for now. Though we are going to be keeping that on the tight leash. Typically, energy is very volatile and gets hurt in recession. So we're going to be monitoring that very closely. Healthcare, on the other hand, is another sector that we'll call out here. Valuations in line with the S&P, works well in recessions, works well in quad 4. Healthcare is our largest overweight in our individual equity portfolios. We'll quickly hit on bonds. This is the mirror image of what we just looked at on the last sheet, and that the higher the level, the more attractive. So you look at where yields are by and large near 10 and 20-year highs in a lot of cases, especially on high quality fixed income. You can get 4% in treasuries, 5% in high yield corporates. So again, if rates continue to come in, and with the help of some active management, we think high single digits in bonds are pretty achievable this year, potentially even double digits if we have a hard recessionary landing, though that's not really our base case. So we've got yields on the left. We'll look at spreads here on the right. Just kind of think about this as PE ratios for bonds, but again, in this case, higher is better. So we are underweight high yield, even though it's got a pretty nice yield, but we do prefer emerging markets. You get a pretty comparable yield, a little bit better of a spread relative to its own history, relative to the U.S. Treasuries. So if you are going to look for higher income, we think emerging markets are pretty attractive. Again, they're going to benefit. We're right on our view on the dollar. And then mortgage-backed, U.S. MBS here. These are mortgage-backed bonds that are all underwritten and essentially guaranteed by Ginnie Mae and the federal government. So you get essentially no credit risk like treasuries, though we'll see about what happens with the debt ceiling. But you're getting an extra 40 basis points in yield right now. And given that mortgage rates have risen and they're so high, refinancing and prepayment risk, which is the major risk for mortgage-backed bonds, is essentially zero right now. So you're almost getting a free option over and above treasury. So you will see quite a bit of mortgage-backed exposure in our fixed income portfolios. Last but not least, Jeff, for the third pillar is behavioral. And again, mixed signals, nothing too strong one way or another, though I do want to take a moment to call out a couple of notes on fixed income. Institutional positioning here, very underweight across the board, especially fixed income. Volatility, which is a measured by the MOVE index here, is elevated. So when you've got institutions underweight, high volatility, high hedging costs, you got the macro setup, the fundamentals all line up. This is exactly what we look for with the alignment of our process. And so again, just kind of walking through each piece of the puzzle really gives us a high degree of confidence that while fixed income has struggled, 2023 and beyond should be a really nice year. So don't abandon your bonds. And with that, Jeff, I'll kick it back to you.
No, thanks, Cliff. I mean, thanks for the kind of the outlook for 2023. You reviewed a lot with the Cornerstone dashboard along with the quad and the investment process. What I, to put it in just a couple sentences, what I was taking from it, again, and you provided a lot of information there, with all that's going on, it seems we're still not ready to give the all clear sign, right? We see volatility continuing, especially in this first half, and just when we were talking earlier, just looking at the behavioral part of the fear and greed gauge, right? Maybe a week or so ago, or 2 weeks, it was probably in that fear gauge. It's been moving. We'll see what happens after the last couple of days where that moves. So again, a lot of volatility is not going away. As you mentioned, still elevated. So with everything that you've been talking about, how do we start positioning our client portfolios, and what's the investment team's thesis on the positioning on these accounts right now?
Yeah, that's a great summary, Jeff. While there's some silver light at the end of the tunnel for 2023, we still are going to maintain defensive exposures really across all asset classes, with an eye toward, if we do go into slowdown or recession at some point in 23, coming out of the other side of that, when the Fed does pivot, when the Fed does cut rates, when valuations have come down, when earning estimates are in the trough, that's when we're going to really, want to get more aggressive and look for upside. So more likely a 2024, late 23 or maybe even 2024 story there. So high level positioning, again, playing defense. 2023 is at least going to start with quite a bit of defensive posturing. From an asset class perspective, we favor bonds over alternatives, and then alternatives over equities. So we think we can get mid to high single digits across the board, perhaps low to mid single digits in stocks this year, but likely going to be some volatility on the front end, and then strength on the back end once we do come out of recession. As far as equities go, more defensive sectors. We mentioned healthcare, others that we favor in quad 4 late cycle, consumer staples, utilities, REITs. Those are your bond proxies, things that typically do well when interest rates come down. From a factor perspective, we like low vol, low beta kinds of stocks, high quality, high dividend yield, defensive types of names that's highlighted here in the green. In bonds, we like I said, we like bonds. We like duration. So in this kind of environment, you do want to have interest rate sensitivity, as our clients may be aware, as bond prices and interest rates move inversely to one another. So if we think rates have peaked and will start coming down, that's going to be good for bond prices. So not only income, but the potential for total return. Well, we want high quality. So things like treasuries, mortgage-backed bonds, investment grade credit, if you want credit exposure. Not big fans of high yields or leverage loans, things like that in this environment. And then last but not least, we'll hit on alternatives as they've become a more and more significant part of what we do. Again, we like the relative value, market neutral kinds of plays, things that we're frankly invested in now. As interest rates are higher, you kind of reset the baseline expectation of what you can get in those kinds of strategies. So at 4% treasuries, you build in a risk premium of 2 to 3% on top of that. I think alternatives look pretty good, but you want to make sure you've got high liquidity so that you can be opportunistic. So that's what I had for us today as far as prepared remarks go. Jeff, I do just want to take a moment to personally say thank you for our clients and our friends who tuned in and have shown interest in our webinars and our outlooks, and then more importantly, thank you for the opportunity to come and work for you each and every day. We love what we do. I think you can see that a lot of time and energy goes into our process, and we're really proud of what we built, and ready to take whatever 2023 has in store for us head on. So with that, Jeff, I'm happy to take questions. I'll turn it back to you to take us home.
Yeah, thanks, Cliff. Again, I know a lot of information to go over as always, especially as we start the year. So thank you to you. Thank you for the team for preparing and sharing this information with everyone today. So, Cliff, as we close out today's session, I was reading an article during the holidays, and I wanted to just share it quick, not share the whole article, but it was talking about which country is the happiest on earth. And so, Cliff, I don't know if you know, but Finland is the happiest country on earth. And there was 3 things that they shared on why the Finns are so happy. One was true happiness is set by your own standards, not by comparing yourself to others. The second was spending more time in nature, provides a peace of mind and revitalizes you, provides a higher energy, better relation with nature, the better you tend to feel. And then the third was just being a good steward in your community. Acts of kindness, opening a door for our fellow man, woman, saying hello, right, to someone on the street. So hopefully we all find some greater happiness in this year ahead. I just wanted to share that with you all. And then on behalf of Cliff, myself, and your team here at Cornerstone, we thank you for joining us today. We appreciate the trust and confidence you've placed in the Cornerstone team. It is and will never be taken lightly. So we appreciate you all. Keep an eye out from the email for the replay. Share it, as I mentioned, with friends, family. If there are folks that we can help, let us know. Let us know what we can do. If there's questions out there, again, a lot has gone on. A lot will continue to go on. So on behalf of everyone at Cornerstone, we wish you all good health, wealth, and happiness in the year ahead. Thanks for joining us today.